Although my name is Brett Hirsch, I'm instructor at overnightaccountant.com. I'm a tax professional that helps folks reduce their taxes and properly file their tax returns. And what I want to discuss with you today is a little bit on the 2018 tax update for individuals. What we're going to be discussing is the tax changes that were imposed by the Tax Cuts and Jobs Act of 2017, the TCJA as we pros like to call it. We're going to go over some of the changes and how they are going to impact personal returns. These are just a few of the changes that occurred. They're going to impact many individuals. There's many other changes that are going to be a little more rare. These are going to cover some of the major changes that will impact your return for 2018. This is not a 2-minute tax take, so I don't think I can do it in 2 minutes if you're familiar with our website and what we do, but let's go for it. Let's go through these tax changes. Number one, that postcard, the simplification of the tax code to the point where you can file your taxes magically on a postcard of just front and back. You're going to see the 1040 has been changed to look like a postcard, which you're going to print out on a full sheet of paper, which half a sheet, half a page on each side is going to have stuff on it, lines and whatnot. That's a myth. It's not going to happen. Not for a vast majority of you. That postcard myth is really, it's what I said. It's a myth. It's not going to simplify tax filing, and in fact what it does is made it much more complicated until, for at least for a few years, until we figured out all these different forms and schedules that have been created. There are now 6 new schedules. Let me see how I do this. 6 new schedules that you're going to have to complete before, many of you, before you're able to plug the numbers from the schedules onto your beautiful postcard that simplifies everything. They're brand new schedules. They're still in the draft stage. The instructions have not really been written for them yet, so it's going to be a fun tax year. So let's get ready. Number 2, refund frustration. I'm not going to have these numbers, but I'm going to call this number 2. A lot of folks during the year when they had the Tax Cuts and Jobs Act was passed, they would change the withholding tables because they wanted to get those tax cuts out to people as quickly as possible. Well, what happened was when they did that, when you file your tax return, many folks are going to be surprised that they're not going to get the refund they thought they did before because that refund was broken up every paycheck you got during the year. So just be prepared for that. And also when you did the new W-4 forms, which are filled out, which you tell your employer what to withhold for you, it doesn't include the credits unless they made a really bad attempt to do it. So it's the correlation between the amount of refunds you're going to receive this year, the amount of tax you owe, and what was withheld. It may be skewed for many, many people. It may be quite different, and as a result, many of you may not receive the refunds you anticipate, and you could even owe some tax. If you're in that boat, we advise, or I would advise you, or I would implore you, if you want a refund next year, change the W-4 form, change it to single, do somehow to maximize your withholdings to a certain extent so you get that refund or you don't owe tax next year. Good news, tax rates were reduced in this Tax Cuts and Jobs Act bill, or law now I should say. Rates are reduced. Most of you guys are going to pay less. However, some upper middle class folks are going to pay slightly more. Folks on the upper end, it benefits them, but as a percentage, you're going to find that many folks in the lower middle class and the middle class really did benefit from these tax acts. The brackets will now be adjusted for inflation using a different metrics, which may actually make the tax brackets increase slower, which will be a net result of possibly an increased tax on everybody over time. I hope that makes sense to you. The marriage penalty was reduced, and that's a good thing. That means a married couple filing jointly with the same income is going to pay about the same as they would if they were single filing the same income for those individuals. So the marriage penalty has been reduced. Personal exemptions are gone. Now this is kind of a big deal. What most folks call these are their dependents. Can I claim my kid as a dependent? Can I claim mom as a dependent? Can I claim that guy's living with me in the house that hasn't done anything for 3 years? Is he a dependent? Those no longer exist. So I guess in some way that simplified things to a certain extent. However, that $4,000 or so you got each year for each dependent, it's gone. That includes your personal exemption for you and your spouse. However, and this is exciting, all those dependency rules, which are still called that, they all remain intact. And all those rules determining if someone's a dependent or not, they're still there. But now they're used to determine many credits and also many deductions. Those same rules are still there. It's still just as complicated. You just don't get the $4 grand. And actually, some of these deductions, the amount of money you save from the $4 grand per person, I'm rounding about there, it was actually offset by increases in the child tax credit, which we'll discuss in a second, and also increases in the standard deduction. So they were offset. The elimination of these dependency deductions was offset by these changes, which I'm going to discuss one now. That's the standard deduction increase. That did increase. It is now $12,000 if you're single or married filing separately. And that is really cool because if you have kids working for you, you have a small business, and you find them something to do that they can actually do when you pay them a reasonable wage, that $12,000 can become tax-free. Put that money in a Roth IRA. Free tip for you. Okay, $24,000 married filing jointly, $18,000 head of households, now your standard deduction. $1,300 boost if you're married and you're elderly or disabled. $1,600 boost if you're elderly, disabled, and you're single. Itemized deductions. Now, a lot fewer folks are going to itemize simply because the standard deduction increased so much. Home equity loans, however, they're pretty much gone for most folks as far as a deduction. And that is because they can only be used now the interest on them can only be deductible if you build, acquire, or improve your primary residence. That's pretty much it. That's very few people. If you use that home equity line to buy a car or do something else with it, send the kids to college, that interest is no longer deductible. State and local tax deductions, you probably heard a lot about this in the media. It's limited to $10,000 now. There's really no real workaround for that. The states are trying to do it, but everything you're trying to do, it just violates tax law. Just basic premise of tax law. If you do a charitable contribution, you can't get anything back from the state for it, even if it's a credit for other taxes that were paid. It's a shell game. It's not going to fly. Okay, 2% miscellaneous itemized deductions are completely gone. Excuse me. Now, the biggest one there is employee-related expenses. If you're used to like deducting your mileage and a lot of things on Schedule A because maybe you're a salesman or a driver and your employer gives you a W-2, those are gone now. And for a lot of folks in that situation, that's going to be a big deal. I suggest you talk to your employer about what is called an accountable plan. If they don't know what one is, you can have them call me up or send me an email. Probably send me an email. I can help them out with it. All right, what about alimony? Alimony, after this year, it is gone as a tax issue. 2019 and beyond, alimony paid is no longer a deductible. And alimony received is no longer income. That simplifies things, but a lot of people aren't liking it. So there's a big tug and pull here, depending on what party you are in a divorce. You only got a few days because I'm filming this right at the end of 2018. So you got till 2018 to get that divorce final if you want to deduct alimony and have your spouse pay taxes on it. After that, nope. It's not going to happen. Child tax credit. This was actually doubled to $2,000 in 2018. Now that's a good thing. Now basically it's for people that are age 16 and younger. Now the phase-out amounts for this are much, much higher now, so a lot more people are going to get that $2,000 per child, and that's really one of the things that really helped the middle class was this. But now folks up to $400,000 if you're married filing jointly, excuse me, they're going to get the deduction. So that made a big difference for a lot of folks. That actually, like as I said earlier, they got rid of dependency exemption, so this was kind of a trade-off. Now, even if you got a child that's over 16 years old, which is before you didn't get this because you got the dependency exemption, but now you're going to get $500. For a lot of folks, that's not going to be as much money as a dependency exemption. It's not going to be as valuable, but they gave you something, and it's not refundable. Energy credits. All right, there are a couple changes here, but mainly these things just kind of expire. Most of the home-related credits related to energy are now eliminated or expired. This 30% credit for qualified solar, wind, and geothermal. That's a big deduction or a big credit for a lot of folks. That still exists. Now, this is wrong here. This is the end of 2018. The $7,500 electric car credit, it expires at the end of 2018, not 17. So if you want to get an electric car, you've got about 2.5 weeks to do so. It has to be all electric, not a hybrid. Health insurance penalty, it is still in effect for 2018. Many people think this is not a Tax Cut and Job Act issue. I think it was a separate bill. However, that penalty was removed, but it doesn't take effect until next year. So for 2018, if you didn't have insurance, it is still there, but it's eliminated for 2019 and beyond. Remember, however, that the IRS really has no teeth to collect this penalty. If you're sending in payments for taxes due, make sure you tell them it's for taxes and not this penalty, unless you're really a good citizen, which I advise, and you want to pay the penalty to the Internal Revenue Service. So that's it. Remember, I'm Brett Hirsch. I'm with OvernightAccountant.com. We invite you to peruse our courses and hopefully buy a course on taxes. And if you need any help with anything, you check out the video that I have, or the article I have related to this video. If you need help with your taxes, please keep me in mind. Thank you so much. Have a great 2019.